A simple formula that you can use when you're making offers on multi-unit rental properties. What's up, everybody? It's Jamel Gibbs, your family-oriented entrepreneur. Welcome to another video. So in this video, I'm going to share a simple way to approach making offers on multi-unit rental properties. What we're going to do today is focus on multi-units, meaning 2-family apartment buildings and up. If the property that you're looking at has a minimum of 2 units or more, then this formula can work for you. I'm going to go into detail on a real live deal that I'm actively looking to make an offer on, and I'm going to underwrite it on this video so that you can see how the entire process actually works. Now, I want to be clear that this is not a formula that I created. This is something that was taught to me, and I'm just passing on the information with the hopes that it's going to benefit you if you're looking at multi-unit rental properties as well. This is the actual property that I looked at just yesterday morning. This particular property has 3 different units in it. You can see that the seller is asking $245,000. The property does need a lot of work, I will say that, but there's an A, B, and a C unit on this particular property. It's a 4-bedroom total, 3.5 bath property. Okay, and if you scroll down, you can see that the property was built in 1939. Scroll down a little bit more. You can see that there's some basic information. There's no sign. It's being sold as is. You can see that the property has been listed for a little over a month. So since January 20th. Now, they had a price reduction 13 days later, almost 2 weeks later. They reduced the price from $250 down to $245. Now, notice this. Back in December of 2021, the property was listed for $145,000. All right. And they had a pending sale at $145,000. Before that, back in August of 2021, you can see that the property was listed for $125,000. So this tells me 2 things. Either the seller is fishing for an offer, and for them to raise the price to $245,000, they're literally just fishing to see if they can sell the property for more money, or there's some level of motivation. The seller needs money. After looking at this property needs a tremendous amount of work. To me, it needs to be gutted out. The roof isn't bad. The exterior needs some work. The windows aren't terrible, but the interior needs to be gutted out. In the first unit, in Unit A, the tenant actually left some stuff behind. They left the water running, which is running up the landlord's bill. But all of these tenants in this property are month to month. If I were to buy this property, I would want this property delivered vacant because I need to gut the entire place out. To me, it's not in a livable state for these tenants, and I would want to put my own tenants into this property. But we're going to base today's numbers in this video on the actual numbers that the property is bringing in the current condition right now. And also, here's a video that I shot from the front to the side of the property showing you what the exterior of the property actually looks like. Now, what we're going to do today is use Google to get some basic information, and we're going to combine that information with the formula that I'm going to show you in order to come up with our offer price on this particular property. So being that this is a residential property, anything between a 1 and a 4 unit is considered to be residential, not commercial. Anything above 4 units is considered to be commercial. So if you had a 5-unit apartment building and up, then you're talking about a commercial type of real estate deal. But this is a 3-unit triplex, which means that it's a residential property. So I can base my rates on a residential loan. Okay, so if I were to get a loan on this property, let's say a 30-year fixed, as of today, you can see that there's a 7.346% interest rate that I would base my numbers off of. When it comes to the offer formula, there's 5 key steps that you need to address in order to come up with your offer. The first one is finding out the NOI. That means net operating income. When you're looking for the NOI, all you're doing is taking the gross rental income over the course of a year, and you're subtracting the expenses over the course of the year, and that's going to lead you with a net amount of income that you'll have from the property. Then what you're going to do is you're going to subtract the amount that you want to put in your pockets every single month as an expense as well. And that's going to leave you with the amount that you can pay on a monthly basis on a mortgage in order to be able to purchase this property. Once you have the mortgage amount that you can pay every single month and you figure out your purchase price, then all you're going to do is subtract the repairs that the property needs, and that's going to leave you with your offer. I'm going to show you how to do it on real numbers, and then I'm going to show you hypothetical numbers using a scenario that will work a little bit better on this particular property. So I'm going to pull up a document that was sent to me from my buyer's agent who is representing me on this particular deal. Looking at this information here, you can see I have the total income of the property, and then I have the expenses below. So they kind of made my job a little easy when it comes to finding the net operating income, but I'm going to verify these numbers and put it up against my numbers to make sure that these numbers are valid. But when you're looking at the rental income on an annual basis, if you add these three numbers up, it equals $18,511.39. So that's the total gross income, rental income from this particular property. That gives me the income portion of the NOI. Now I need to subtract the expense portion. Now the expense portion is down here. Now, as far as the expenses, you have taxes, you have insurance, you have management, advertising, and all these other things. I'm not going to use advertising and repairs. I'm going to do that separately. Accounting and all of that stuff, I'm going to do all of that stuff separately, right? What I am going to use is the tax information, the management, and the insurance, but I'm also going to add vacancy, I'm going to add maintenance, and I'm going to add an emergency fund on this as well. So I personally use taxes, insurance, management, vacancy, maintenance, and emergency fund or reserve. Now, looking at this information here, if I'm looking at the taxes, and if I add these three numbers up, it equals $1,615.14. Now, I did go to the tax assessor's website to verify that the annual taxes on this property is $1,615.15. That's literally what they just paid on their tax bill. So these numbers are correct. Now, when you're purchasing the property, the number may change a little bit because you may be purchasing at a higher price or maybe even a lower price than what they've purchased at. And that's going to obviously reflect you. If you put rehab into the property, that's going to affect the amount that you're going to pay in taxes as well. So you may want to compensate for that. But for preliminary number purposes, let's just use the information that they have. And that's $1,615.15 over the course of a year on taxes. As far as insurance, they're paying $462.99 in insurance, which equals $5,555.88 over the course of a year. Now, as far as management, I did the math on what they're paying in management. Typically, management is going to be somewhere between 8 and 10%. But they're paying 7% of the gross annual rental income, which is $1,304.64. Now, along with that, I don't see a vacancy rate in here at all, but there's definitely some vacancy. In fact, when I went to go see the property, one of the units is vacant. These are month-to-month tenants. So adding in a 5% vacancy rate leaves me at $925.56 over the course of a year. Now, along with the vacancy, I'm going to add 5% for maintenance as well, which is another $77.13 a month or $925.56 over the course of a year. Now, along with that, the property is going to have some issues. So you want to put some money away just in case something happens on the property. And we call that an emergency fund. Some people call it a reserve. And that's going to be 10% for me. All right. So I'm going to put $1,851 over the course of a year away in order to be able to take care of the property in case something goes wrong. So if we add all of this stuff up, it equals $12,177.79 for the year. Now, if I pull up my calculator and I add the annual income, which is $18,511.39, and I subtract the $12,177.79 in expenses, that leaves me with an NOI, net operating income, of $6,333.60. Let's just say I wanted to pay myself $200 per unit. I'm looking at $600 a month. 12 times $600 is $7,200. So if I subtract $7,200 from this, you'll see I'm automatically in a negative of $866.40 just for paying myself on this property. So based on the numbers that I'm looking at on this particular sheet, as well as the asking price and everything else that's involved, not including rehab, not including a mortgage payment or anything like that, the numbers doesn't make sense on this property. It's not bringing in enough income in order to be able to support the property in general. But let's use some hypothetical numbers where this property would make sense. Now, again, as of right now, the property is only bringing in $18,511.39. If I divide that by 12, that means the property is only bringing in $1,542.62 as of right now. So what would make this a good deal? So if I were to work these numbers and use hypothetical numbers, let's just say that each apartment was bringing in $1,000 per month. Okay, so $1,000 per month times 3 would equal $3,000. You multiply that by 12 and that equals $36,000. So if I keep the expenses exactly the same, but I raise the rent to be able to match the $36,000, could I make this a good deal? So let's subtract from the $36,000. Let's subtract the $12,177.79 on this particular property. That would leave me with an NOI of $23,822.21. Okay, so all I did was take the new amount, if I were to raise the rents, and I subtracted the expenses, the existing expenses that are currently on the property as of right now. Let's use the same amount of cash flow. Let's say I wanted to pay myself $600 a month, which is $200 per unit, which is $7,200 a year. So that would mean I would have to subtract $7,200 from that amount. And that leaves me with $16,622.21 that I can use in order to pay my mortgage. So now that I know that I have $16,622.21, if I divide that number by 12, that means I can pay $1,385.18 per month on a mortgage based on these numbers. So if I pull up today's interest rate of 7.346% and I pull up the mortgage calculator using today's interest rate of 7.346%, all I have to do is adjust this loan amount number in order to match what I can pay on a monthly basis. At $150,000, I'll be paying a little over $1,000 a month. At $175,000, I'll be at $1,211 a month. Or what about at $200,000? At $200,000, I'll be right at $1,384 a month. Now, remember what I said I can pay on it. I said I can pay $1,385.18. So I can actually be all into this property at $200,000 in order to be able to make this deal work. Now, the seller is asking for $245,000. If the property was currently bringing in $36,000 a year, I could pay $200,000 for this building and it would make sense for me. And that's before subtracting the repairs. But now what we have to do is figure out the repairs. Now, I went to go see the property personally, and I can tell you that this property easily needs at least $60,000 to $70,000 in work. Okay, normally if the property was in decent shape, you would put about $5,000 to $8,000 per unit in repairs into the property. But this property, in my opinion, needs a lot more work than that. So we're going to say $20,000 to $25,000 per unit in order to get this property where it needs to be in order to be able to raise the rents to a decent amount and be able to cover the payments and get a decent deal on this property. So with that being said, I'm going to go with a $75,000 rehab budget and put an additional $5,000 on top of that for miscellaneous things that we don't even see that's behind the walls. So that's going to leave me at an $80,000 rehab budget. So if you take $200,000, you subtract an $80,000 rehab budget, I'm at $120,000 on an offer on this particular property. And that's only if this property were bringing in $36,000 per year in income. So as you guys can see, all I did was take the net operating income, the NOI, I subtracted the amount that I want to make on a monthly basis in the form of cash flow. That gave me the amount that I can pay on a mortgage every single month, adjusting that based on today's interest rate and subtracting the repairs left me at $120,000 offer. Now, if you remember, a couple of years ago, this property was listed initially for $125,000. So would it make sense for me to offer $120,000, knowing that at one point they were listed not so long ago for $125,000? Would they accept it? It's possible. But these numbers would only work if the property was bringing in or could potentially bring in $36,000 a year. Again, this is not a formula that I created. I learned this from somebody else. But, based on this formula, this is how I underwrite all of my multi-unit deals. You can even use this for single family as well, but I use a different formula for single family properties and land and creative finance deals and things like that. But should I make an offer on this property? Should I walk? What do you guys think? What would you do if you were in my situation? Leave a comment in the comment section. I hope that you guys benefited from this video. Be sure to like it, subscribe, click the notification bell. I'll see you guys on the next one.